the controls so that we'll go ahead and get underway here today. Thanks all. To you, Andrew.
Hi. Hi, everyone, and thank you for taking the time to be with us here today. Today's webinar is called What's the Next Big Theme? My name is Andrew Little, research analyst over here at Global X ETFs, and I cover our suite of thematic ETFs. Global X was founded in 2008, and in the 12 years since, we've become known as a leader in identifying undiscovered investment ideas and developing solutions for our clients. We are an ETF issuer based out of Manhattan with over 70 ETFs and over $12.3 billion in assets under management. Many investors know Global X for our income suite, which includes the super dividend family of ETFs, as well as our rapidly growing thematic growth ETF suite, which consists of 17 individual ETFs and one fund of funds ETF. Today's session will focus on thematic disruption and growth, primarily in technology. But first, I think it is prudent to start off discussing two different investment approaches. Many portfolio managers, especially today, build portfolios with two sets of considerations in mind. The first set of considerations are rooted in what they have learned from the past. As such, many strategies are based on the expectation of historical stock patterns repeating themselves in an effort to outperform a broad market index. The second set of considerations are based on their expectations for the future. This is where thematic investing sits. Thematic investment ideas are forward-looking in nature and are based on the premise that future themes represent paradigm shifts. They are, for the most part, unlike a lot of what we have ever seen before. How are we going to cover this today? To dig in, we'll start with an overview of thematic investing based on our research from the past few years, also taking a peek as to why the time for thematic investing is now, in our view. After our general overview, we'll dig into some particular investment themes that we see as especially disruptive and exciting, explore how they relate to each other, and then talk about this type of investing in a portfolio context. So what is thematic investing? Broadly speaking, we define thematic investing as a top-down approach where we identify disruptive macro-level trends and the underlying investments that stand to benefit from the materialization of those trends. This involves a two-step process. First, identifying themes that we have a lot of conviction in, and second, working with index providers to create methodologies that capture the universe of companies that play off of these themes. By nature, thematic investing tends to be growth-focused and unconstrained by geographic and sector definitions. Many people ask, how do we choose the themes that we launch in an ETF? It really comes down to a three-part test. One, we must have high conviction in the theme playing out the way we expect it to. Two, the theme must be investable, meaning a basket of stocks must exist with high exposure to the theme. And three, the time frame must be long-term oriented, ideally decades long, or evergreen in nature. All three steps are essential to launching a passive thematic ETF, but identifying which themes are investable is one area where asset managers can truly differentiate. You want to make sure that the themes aren't too early on, meaning again that there are publicly traded stocks with high exposure to the theme. If the majority of funding comes from the private market, VCs and private equity, for example, it may be too early, or the theme might be too granular at that point. You also want to make sure that the themes aren't too mature. With these types of vehicles, we are trying to invest in themes that are actively disruptive, not ones that may have been at one point and have ceased to. These are long-term investments, again, expected to pan out over many years or that stay relevant and disruptive, now and into the future. Thematic investing is often used to broadly describe a forward-looking investment approach, but we believe it's important to distinguish between two distinct types of themes, cyclical ones and structural ones. Cyclical themes occur somewhat regularly across short or medium-term intervals, typically based on changes in the business cycle. They can be mean reverting, so that over a long period of time, they tend to perform on an averaged out type of basis. Structural themes occur as one-off shifts that change existing paradigms. They tend to be longer term in nature and are typically driven by powerful forces such as disruptive technologies or changing demographics and consumer behavior. Our preference is to focus on the long-term structural themes, but as we will discuss today, cyclical factors can still play a role in near-term returns. Structural themes tend to follow an S-shaped adoption curve, pretty fittingly. The S-curve shows slow initial adoption as innovators take on a risk in a new technology, and then more and more individuals, the early majority, start buying in, rapidly accelerating adoption, which is illustrated by the steep middle part of the curve. Eventually, the tech gets adopted on a larger scale by the general public, late majority adopters, even laggards, and adoption tapers off at the top of the S-curve, as you can see. While the shape of these S-curves can vary significantly, many important technologies over the last century or so have loosely followed the S-shaped adoption pattern. Looking to electricity, for example, we see rapid growth in the middle part of the S-curve occurring over the first 50 years or so of the 20th century. But more recently, we've seen these technologies become ubiquitous or ingrained in our societies and economies at an accelerated clip. Look at the internet, for example. On our chart, it pops up in 1990 and skyrockets to where it is today. Where technology lays on the S-curve can provide useful insights on its characteristics and how it might grow moving forward. Technologies that are very early in their adoption represent higher risk, higher potential reward, whereas more established technologies tend to be more predictable, but with less potential upside. Social media, for instance, is one theme that has seen massive global adoption, but we're still seeing solid growth rates and new monetization opportunities. Adoption doesn't necessarily mean full market penetration, and when we think thematically, we need to be thoughtful and creative in thinking about how these technologies pan out and should grow in the future. Why consider thematic investing now? We really think it's an important time for investors to consider incorporating thematic investment strategies in their portfolios. We think rapid advancements in technology and changing consumer preferences are disrupting existing paradigms throughout the economy. Again, this is best illustrated by the middle part of the S-curve from before steepening. Many sectors are in the crosshairs of these disruptive themes. For example, the consumer discretionary sector was for years oriented around baby boomers and Gen Xers, primarily through brick and mortar stores. Today, however, the sector targets millennials and relies on online mediums like e-commerce platforms to reach them. And the new paradigm also shows somewhat of a thematic convergence. Social media is an essential part of reaching these younger audiences, and the success of those platforms, mainly in the communications services sector, can then impact consumer goods. The emergence of lithium and battery tech, too, could upend the existing energy complex based on the extraction and sales of fossil fuels. Further, this has impact on autos and manufacturers as combustion engine vehicles are phased out in favor of electric ones, and the world increasingly relies on renewable energy. Robotics and AI also has the potential, and already is, dramatically changing the existing landscape for industrial manufacturing. Automation streamlines processes, and coupled with AI, can be made more efficient, allowing for quick and more accurate production, also with improved worker safety as a benefit. And we could go on and on. Disruptive and secular trends and the thematic ideas that play off of them are changing the way we think about sectors. Sectors that may have previously been thought of as entirely separate are seeing disruption due to the same technologies. In some ways, the very way we think about differentiated sectors is being disrupted in itself. One such thematic area and technology is the idea of the Internet of Things. The Internet of Things, or IoT, describes a growing network of connected things that contain sensors, chips, processors, and have the ability to interact with other devices over a network. In our daily lives, IoT devices are our smartphones, wearables, and virtual assistants that for the most part make us more productive. Increasingly, though, they are also the data collecting sensors embedded throughout cities, connecting robots in factories, and also connecting medical devices with doctors, patients, and among hospitals. The number of connected devices is expected to skyrocket over the next decade or so. There are some estimates that the number of connected devices will reach 75 billion by 2025, up from just 20 billion today, or 20 billion in 2018. So what's driving this? For one, Moore's Law, which is the idea that the number of transistors per square inch on an integrated circuit or microprocessor approximately doubles every 2 years, while the cost of computation is halved. Network-enabled chips and sensors are smaller and cheaper than ever before. The cost of connecting a device to the internet is plummeting. A Wi-Fi chip can cost as little as 10 cents, and it can fit into a light bulb, making it a smart light bulb. The internet is also faster than ever, and with the rollout of 5G networks, it's only getting faster and more powerful. Up to 100 times more devices can connect to a 5G network at once compared to our current 4G ones, which is definitely advantageous in a world where everything is connected. And this increased capacity doesn't compromise speed. With 10 times less latency than 4G, 5G means that devices can send and receive data almost instantaneously, which can be especially critical for certain use cases like in autonomous vehicles or in medical appliances, any kind of medical care that requires any sort of that connectivity. How is this accomplished? Instead of the fewer large cellular towers that supported past generations' networks, 5G networks are 100 times denser. They're comprised of many more small towers that have shorter range, but are more powerful. They're found atop buildings, light posts, just about everywhere. And in the coming years, hundreds of thousands of 5G towers will be deployed across the world, covering up to 65% of the global population by 2025. And finally, strong demand from consumers and companies really enforces the future case for IoT. Again, Internet of Things. 127 new devices connect to the internet every second. And looking at a recent survey of public and private sector decision makers, 85% currently use IoT, with 94% expecting to use IoT also in the next 2 years. And there's good reason for this. Some estimates have IoT adding between $4 and $11 trillion of annual economic benefit by 2025. The Internet of Things has the potential to transform societies, economies, and could become an essential part of infrastructure. It exists at the convergence of older technologies and new and disruptive ones like robotics, artificial intelligence, autonomous vehicles, smart home devices, you name it. Looking more closely at autos, some modern cars are equipped with over 200 sensors. These sensors record simple stuff like data from GPS systems and on engine health, but some of them like radar, ultrasonic, and LiDAR sensors record sophisticated information on vehicles' surroundings. Disruptive technologies in the Internet of Things can give meaning to this data and put it to use. For autonomous vehicles, edge computing and IoT connectivity between vehicles and infrastructure make it possible to analyze and transmit proximity data in real time, enabling split-second autonomous driving decisions without compromising the safety of those on board or even in surrounding vehicles. The idea of a smart city also brings this to life. Smart cities are urban environments where information constantly flows between connected devices, citizens, and centralized decision-making hubs, optimizing how cities operate and improving the quality of life for those that live in them. This can mean using data from connected cars, again, and road-embedded sensors to get a better picture of what's actually happening on the streets, using it to create instructions for connected traffic lights or to shut down streets and avenues. It can also mean using connectivity to more intelligently manage utilities like electricity and water. Over the next 20 years, it is estimated that smart grid benefits will be as high as $2 trillion across the United States. These same enhancements can be brought into the comfort of your own home. Already, many rely on their smart assistants to optimize their daily routines, and we only see these types of use cases expanding moving forward. Imagine it's Monday morning and it's the year 2030. You're asleep, but your smart home is very much awake, getting everything ready so you can kick off the week right. Your morning coffee is already brewing in the kitchen. Your smart assistant's going through your calendar to make sure you're ready for the day ahead. The perfect outfit already awaits you in your closet. Not too formal, not too casual, engineered for the day ahead. And breakfast? You have a breakfast meeting but don't like to leave the house with an empty stomach. Your smart assistant knows this, and while you're sleeping, puts a muffin on the counter. I could go on and on, but it's clear how ubiquitous this could become, at home and on the road, in cities and in factories. We believe that the companies that could potentially benefit from the emergence of the Internet of Things consist of device manufacturers, network providers, and semiconductor manufacturers. These are the companies that make the components along the IoT value chain. We are looking for devices that are connected and the tech that makes them connected, and want to focus on how we think this theme will evolve in the years to come. Pivoting now to another one of our themes, cloud computing. Cloud computing describes the availability of IT services from basic infrastructure such as compute and storage to application development platforms and specific software applications that leverage pooled resources and economies of scale. These services are often hosted remotely and accessed directly over the internet. They can be segmented into the following: software as a service. Think of online software, something that you might use to do your taxes or to watch Netflix or stream at night. There are platform as a service cloud computing companies. These are companies that create platforms for creating software applications on the internet, which are then delivered by different users of that platform. There's also infrastructure as a service. Think about your classic IT room with cords and wires everywhere, but all up in the cloud, and you can purchase it as you go. Sounds a lot simpler. And then finally, data center REITs. The storage needs to be physical somewhere. Then kind of on the edge and more tangential, you have your public cloud and edge computing component companies, the components that make all of the cloud computing processes possible. Some are specialized, others are just general components that are now sophisticated enough for this type of technology that we see in the cloud. An example here being the chips that are built into servers, specialized network switches, and routers. Cloud computing is another disruptive theme that we really think transcends traditional sector impacts in a number of ways and through multiple channels. There is immense flexibility when it comes to the different functionality cloud storage and computing offers. Just in the software as a service segment, we see applications ranging from more horizontal ones like enterprise resource planning and customer relationship management, CRM, to more vertical ones that serve particular industries like healthcare. Similar to IoT, cloud has synergies with a number of other emerging technologies. IoT-derived data flow through and transmit into clouds and are also stored there. Cloud offers massive compute and storage capacity, providing the infrastructure necessary to process big data from the Internet of Things and run AI applications that deliver instructions for connected devices in smart homes, cities, factories, all of these different settings that we've mentioned before. It's also increasingly used to power modern consumer applications like high-quality streaming, augmented reality, virtual reality, and gaming. The remote but accessible storage aspect is also extremely valuable. The days of scrambling for medical records are soon to be over. They can now be stored and centralized in the cloud, making them easy to access and share with medical providers regardless of location. Why do we think it's a good time to invest in cloud computing? In our view, it presents an attractive financial model that allows for potential long-term and healthy growth. Assuming a quality product, regular subscription fees generate steady and projectable streams of revenue as applications with minimal fixed costs become more and more ingrained in subscribers' business operations. And once these companies are in the door, they've established a direct-to-consumer medium through which to offer an expanded application suite that works in harmony with already ingrained products. Revenue and sales trends tell this story nicely, as both have consistently improved among most cloud computing companies. Some people might say heightened revenues could show unhealthy growth for the sake of growth, or the continual valuation of these companies above what current revenues would indicate could be a red flag, especially as the total addressable market is further penetrated and the cost to acquire new customers rises. We don't have this concern. While the cost to acquire new customers has ticked upward, so too is the average lifetime revenue value per customer, and at a greater rate. To speak generally, existing customers are paying more, and those who aren't leaving. And again, the software itself presents a minimal fixed cost to the producer, multiplying the margin impact. But it also just makes sense thinking practically. Cloud solutions address many of the pain points companies and IT operators have dealt with for decades. Given that public cloud infrastructure is operated by a third party, IT personnel no longer have to spend hours on maintenance and are in turn freed up to work on other tasks while saving costs. And gone are the days of proprietary hardware and network protocols. The cloud is designed to be interoperable, even as companies employ hybrid approaches with some applications hosted on-site. I also think it's important to show how thematic disruption isn't necessarily one-size-fits-all. We saw earlier how all the different S-curves look a little bit different, and depending on the technology, might be adopted more rapidly or disrupt other industries in different ways. A little different than IoT or cloud computing, genomics has the potential to change the way we think about healthcare and the type of care we can provide. The genomics industry can be split into 4 areas: genomic sequencing, which is the process of determining the exact order of one's DNA; computational genomics, which uses computational and statistical analysis to decipher insights from genome sequences and data; gene therapies, which seek to detect, cure, or treat diseases by identifying or modifying an organism's gene expression or functionality; and gene editing, where DNA is inserted, deleted, or replaced at specific sites in the genome of an organism. Taking all of these different concepts together, and the fact that a single gene mutation can cause up to 50,000 different diseases, it is clear that these developments are extremely transformative. What's driving the growth of genomics? For one, the cost of genetic testing has fallen dramatically. The Human Genome Project, which sequenced the DNA of a select few individuals in the early 2000s, cost $3 billion to conduct. This came out to costing around $100 million per genome in 2001, but today, this is closer to $1,000, making it a lot more attractive for doctors and consumers to sequence and gather insights from people's DNA. Further, it is making it possible to cure previously incurable genetic diseases, which could mean targeting commonly known and detrimental afflictions ranging from cystic fibrosis to sickle cell anemia. Currently, many treatments are undergoing clinical trials targeting disease caused by a single gene mutation, but the hope is to eventually treat complex diseases that are caused by many different genetic factors. Alzheimer's, for instance. Some therapies have already been FDA approved, though many are still pending results. Optimistically, the U.S.'s FDA Fast Track program allows for the fast approval and development of certain therapies, including genetic therapies, just based on the potential to cure previously incurable diseases or in instances where those diseases may have been treated less effectively. Genomics is also driving its own growth. Our genetic data is very dense. Expectations suggest that by 2025, the amount of human genetic data sequenced globally could be 20 to 40 times the entire estimated storage capacity of YouTube. But with more data comes more opportunity to define new treatment pathways and to optimize health services. And as a whole, genomics is supported by the rise of precision medicine, or the desire to personalize healthcare. In this context, it means using a patient's genetic information to select the most suitable treatment option for illness, different than in the past when treatments may have been more uniform by condition. For example, many people have the same type of cancer and undergo the same treatment, yet only some will go into remission while others won't. Greater insight into the genetic variation in humans should therefore help explain why some treatment approaches are better or worse for some than others. This visibility may one day help doctors develop completely customized treatments that are rapidly designed and flexibly manufactured for each patient. Across the board, and as you can see on the right, we see double-digit CAGRs across the 4 genomic sub-industries over the coming years. Genomics, biotech, and personalized medicine certainly appear to be the next frontier of specialized healthcare and could improve the lives of countless individuals around the world. From our discussion, it's clear that each of these themes are intrinsically connected to many others. IoT, for example, Internet of Things, sits at the center on this slide here. Connectivity strengthens the case for robotics, could revolutionize healthcare. Think about preventative health and fitness trackers, things that can track your health while you sleep and maybe let you or your doctors know when there might be an underlying health condition. And connectivity also transmits data through clouds that can make AI more valuable. And then on the other side of the coin, connectivity requires enhanced cybersecurity to secure transmitted data. These themes do not exist in a vacuum and can either enable or be enabled by other themes. Most of the time, it's a little bit of both. And sometimes, one theme's success can drive another's. As more robots are brought to factories, for example, there will be more need for them to be connected. This captures our thesis of thematic disruption, and it is important to look at the world around us to figure out what the world in front of us in the future will look like. Where does thematic investing fit in a portfolio context? We think these strategies are best over long time horizons and are for growth-seeking investors. Yet, the challenge is often in how to fit it in a portfolio when it transcends typical geographic or sector classifications. We often find that investors feel most comfortable carving out a thematic or opportunistic bucket in their portfolio where they ignore geography and sectors. This segment often comes out of the equity portion of their portfolio. It's important to think about both the risk and return characteristics of thematic investments, and when creating a portfolio of themes, to try to capture growth while mitigating risks associated with any one theme. One potential approach is to own a basket of themes, weighting them by their forward revenue growth expectations. This helps diversify exposure to any one theme while tilting exposure toward one with higher growth potential. Global X has a variety of growth-oriented thematic ETFs in the technology suite, including ones designed to track social media, fintech, the themes we discussed today, Internet of Things and cloud computing, autonomous vehicles, electric vehicles, even video games. And then within our people thematic growth suite, which is different than the technology suite, we focus on societal type of disruption, including funds that track cannabis, e-commerce, and millennial consumption patterns. And finally, we have our U.S. infrastructure ETF within our physical environment sleeve, as well as a multi-theme ETF that captures a lot of different themes by investing and weighting those themes, again, in the same way we were talking about before. To learn more about what we discussed today and more, I want to direct you to our website, globalxetfs.com. We have a trove of thematic research up there, ranging from short-form blogs to long-form reports, as well as white papers. You can also follow me on Twitter for daily and more frequent updates. My Twitter handle is @a_gx. I try to post frequently up there about all the different things we talked about today, as well as some of the other things we didn't get to talk about. So definitely a great place to get content there. And then always important are disclosures, which I'll flip through now and suggest looking at again when you get a copy of your own presentation. And with that, we conclude our presentation today. I want to thank you all for joining us, and also thank Interactive Brokers for hosting us.
Well, Andrew, I want to thank you very much for your presentation here today. Also, as to wrap up today's event, I do want to show folks how to access the information on the Interactive Broker platform. Now, what I'm going to do is actually take over the controls and share my screen with you so that you can see from the Interactive Brokers website, simply adding Global X into the search field up at the top of the page will bring you to a separate page where you can find the Global X funds that are available on your Interactive Brokers platform. Now notice once I do go through this search, you'll see that it takes me to a page where you can find all of the different funds or the ETFs that we do have available for trading at Interactive Brokers. By the way, I also want to point out that Global X is providing commission-free trading of those Global X funds when you do trade them via the Trader Workstation platform. So please keep that in mind. This is important information. Now, the commission-free trades for Global X must be done via that IB Trader Workstation platform. And those commission-free trades apply to all online buy and sell transactions on the Global X funds or Global X ETFs funds that are listed on this page. By the way, you can access the prospectus and a fact sheet for each of the funds that are listed here. Now, I also do want to pull up the Trader Workstation and show you how you can, based on the IB ticker symbol, you can add those ETFs into any of your watch lists. Notice here we'll add the Genomics one. Simply add that ticker symbol, click Tab or Enter. And you'll see here, notice this will let you know what that ticker symbol is. We'll go ahead and add that. And by the way, it is, you will need to identify this as stock and smart, and it adds that ticker immediately onto your platform. Now, do keep in mind on that previous page, the prospectus and the fact sheet are also available for any of the products, the Global X funds that are available through Interactive Brokers. So with that, it is going to conclude our session here today. I want to thank all of you for participating with us this afternoon and remind you that we have been recording today's event. Each of you will get a direct link to today's recorded playback as well as the webinar notes that we've been using today. You can all exit today's session using the X in the upper right-hand corner of your screen. Have a great rest of your day, everyone, and do watch your inbox for a direct link to today's recorded playback. Have a great rest of your day, everyone. You can exit using the X in the upper right-hand corner of your screen. And once again, thanks to Global X ETFs for delivering today's presentation. Thanks, everyone. Have a great rest of your day.